There we go. Okay. This was kind of an interesting day. 2 days ago, my community got hit with a pretty severe flood, and it's kind of devastated the community where I'm at in Indiana. So, um, thank you for everybody that was patient and allowed us to reschedule for you and for me. It really did help my ability to get out and go help some people. And I myself wasn't affected, but all of my businesses needed to get out and get lend a helping hand out there in the community. There's people who totally lost their everything, and I've been through that. Um, Fun fact about me: I actually had a house fire in 2017, and I lost everything. So a restart from me in 2017, and so I totally understand where these people are coming from that just lost everything to a flood. But anyways, I wanted to bring up this webinar because there seems to be a lot of, I just used the word negligence in people that are sitting on cash and sitting for, waiting for an opportunity to use their money into an investment. And some people have really legitimate issues of just not understanding where to put their money. And that's what this is all about, as to where you can put your money. And we're going to give you the framework on kind of a vetting process to know where you're putting your money and why. There are also people that are just simply waiting for rates to fall. And that in today's market doesn't work, because what we have in today's market is not quite enough of a differential to be trying to wait for the rates to fall. Secondly, waiting for rates to fall is speculation. There's no guarantee or certainty that rates are going to fall. Now, in my honest opinion, I think that there are so many assets and so many opportunities out there that anybody who's just waiting out of, the scare of I can't buy real estate, or I can't buy this asset because the interest rate is too high, that is nonsense. Because what I'm going to go through in this presentation is really just to show you that what you're doing waiting is completely banging your head against the wall. You have no structure in place, and I'm not trying to be rude to anybody, but you are losing money, because you're going to be light years ahead 2 or 4 years, 5 years from now, if you just start buying your assets. Okay. So um, there are a couple people that I wanted, I'll bring up here, not by name, but I spoke to a couple people that are really trying to get one or maybe two additional assets in real estate outside of their primary residence for the rest of their life. And that's all they want. They just want a little bit of trickle. And I can understand that they're waiting for rates to fall, but I kind of had this same discussion with those people, that they're still going to be light years ahead, especially 15, 20, 30 years from now, if they just lock in today. So this is not, that might have sounded like a little bit of a bank sales pitch, and it is not in any way, shape, or form. I'm going to give you a framework that you can use to walk away from this presentation to be able to start looking at things. Okay. And with that being said, I'm going to kind of go through some of these slides with you. And hopefully I create a framework for you. So full disclosure is that this presentation is 5 categories, and 5 vetting frameworks. Finding an asset that falls into 1 or 2 of these is pretty cool, but finding an asset that falls into all 5 of these is unheard of, and it's an exceptional opportunity. So nothing here I'm giving you is, you know, a requirement that it has to fit all 5 categories. You want to check as many of these categories as you can. So I'm also not going to be showing you a specific asset to buy. Some people that know me or may have some history, reading some of our literature. Um, I myself, I invest in barndominiums. Okay. I have a capital fund and we raise money from investors, accredited investors, to deploy into barndominiums. But that's not what any of this is about. This is strictly me trying to educate you as the audience here. So bear with me. I do stand while I do these presentations. So, um, anyways, why smart money stopped waiting for rates to fall. Oh no, we don't want to click that. All right. First and foremost, this is not financial advice. I am not an attorney. I'm not a CPA. This is strictly just a guideline and for educational purposes. So the cost of sitting still, going back to kind of my intro there, is that if you're sitting on cash, you are losing on an average 3.2% to inflation every year. Bottom line, that's historical from 1913 to today. Okay. So losing 3.2% every single year is is a lot. But if you look at the 1970s, for example, the 1970s was a terrible time for people that were sitting on cash because cash lost nearly, was it, half of its value in the 1970s, right? So if you had $100,000 in the 1970s, which was pretty good, that $100,000 in 1980, 1981 was worth $50,000 as to 1969. So the people that were invested during that period of time, they actually were able to sustain the rate of inflation. Okay, so they not only sustained it, but they actually overcame it and came out more on at the end of that. So the people that owned assets outside of their primary, even their primary houses went up in value. They doubled in value. So not only were people invested into assets that doubled, the housing industry doubling, but they didn't lose 50%. They're 4 times more ahead than the person who would just sit on their cash. Okay. So cash is not king. Okay. And since 2020, the United States dollar has lost nearly 20% of its value. That's just mind blowing. Okay. So in 6 years, $1 is now worth 80 cents. And do that with $100,000. You now have $80,000. So if you went into, the COVID era, and then, you were hoping for those rates to stay low forever, you lost because they started going up. And you're like, oh, they'll come back down. If I'm talking to you, you're now caught in, oh, I got to wait for rates to come back down. Just because the rates went up doesn't deter you from finding the opportunity to invest into an asset. Okay. So that's real. The inflation side of things is real. Now we're going to start talking about the upside, as if you were to actually take that money and put it into something. So you're not just hedging against inflation, you're actually coming out with a return on your investment and over X amount of years, right? So smart money just stopped waiting. They've learned this. This is nothing new, right? This has been going on since, before the 1900s. People were investing into things that people knew had, guarantees against inflation, right? Money markets are not them. Your couch cushion, your under your mattress, in your safe, that is not it. You have to be deployed into something that people want, and that's a real asset. Okay. I don't want to go on a tangent, but there are other categories that can fall into a lot of these check boxes that are outside of housing. um, but I'm not going to dive into them. But there are things outside of rental properties. Okay. um, so take that with what you will. There's a lot of you know every and not to specify anything, but the digital currencies. You also have like parks and recreation. You have um, other businesses. You can actually invest and buy into somebody's business and own. It's called a joint venture, so you can venture with somebody through their business, right? So there's a lot of opportunities out there. Who's already done this since 2024, or in 2024? Blackstone. Okay, we all know Blackstone. They bought an apartment owner and development company called ARR Communities for roughly $10 billion. Why did they do that? They did it because they wanted to start building apartment communities. Okay, they didn't do it because they just wanted to acquire another company that was being positive in cash flow, right? Blackstone needed that opportunity so that they bought a company. Going back to my point there, they bought a company that they're going to start cash flowing from, generating a return off of their investment. That company is already operating, and they're building apartment buildings that are going to be rented out. Okay. KKR acquired about $2 billion of U.S. apartment communities. So again, what are they going on? They got the same structure in place. So the build to rent and the institutional capital kept funding new rental opportunities, and this is happening every day. So what a lot of people don't realize is that if you're coming from the side of the aisle of looking at and being interested in investing into multifamily, a lot of people compare multifamily to replacement cost. Okay. And that's very fair all day long. But when you look at residential building and single family, or maybe two duplexes or triplexes, you look at them, you have the replacement costs are higher, but the opportunities are also higher. Okay, because people want to pay a premium to be living in something that's new, and it may or may not ever been lived in. So the opportunities are huge if you were to build yourself. Okay. So the framework that I'm going to be running you through is called the raise opportunity. Okay. That's real assets, acquisition below appraisal, the institutional vacuum, and that is a big one. If you can find that one with maybe one or two others, you are golden. Surging rate proof demand, that one gets kind of tricky to explain, but I'll do my best. Emerging category upside. Okay. So those last two, they kind of go hand in hand, but the emerging category upside is pretty fun to dive into as well. So capital, there's rotating out of paper and into hard assets. So real assets, right? So we're talking about taking my dollars, my cash, what's in my checking account, my money market account. A lot of cases, you can even use your IRA or self-directed IRA, or in your personal investments from that point too. There's a lot of resources out there if that's something you want to dive into, because you can take what you've set aside in your self-directed accounts and you can actually deploy that into real estate. So look at that and talk that over with your financial advisor, your wealth strategist, or your CPA. But physical land, that right? Physical land, physical buildings. Those are the real assets. That's primarily what I'm talking about here. So this is a category that's pretty easy to find and to check this box. But finding one that finding a real asset that fits one of the other boxes is starting to get pretty tricky. Okay. Acquisition below appraisal. Okay. What does that mean? That might sound kind of obvious that, hey, yeah, the bank's going to loan 80% of what it's worth, and um, I'll be putting in 20% or whatever that may look like to you. So again, I'm not trying to point you in any direction of any loan product or anything like that. But acquisition below appraisal. What you have to understand is that as a builder, I have learned that the banks and the appraisers, I got to use my words carefully because it is ironic how close that a bank is willing to finance comes in next to an appraisal. Very interesting because the build cost, as a builder myself, it's really interesting because I typically, here's how the process typically works is I'll give the bank a quote, of what, a line item list of everything that we're putting into the house to build it and develop it. And then they order the appraisal. It's funny how the appraisal is almost 20% more than the cost of my quote. Anyways, I'll leave it at that. So, acquisition below appraisal is just that you have to make sure, and when I say make sure, sometimes you can hire your own appraisal if you want, but don't just take the bank's appraisal for it. Okay, make sure you understand what that property's value truly is, because you might be deceived at a front line or on a sideline point of view. Be into the deal and understand what you're buying. And I don't mean going to Zillow. Zillow is a great tool. You can probably pre-vet stuff there, but I mean actually running the comps. Okay, the physical comps. Talk to a realtor, order an appraisal, do whatever you got to do. The institutional vacuum. Okay, this is about finding an opportunity before the institutions arrive. Okay, that's where things start going parabolic. It's FOMO. I mean, it's a banana chart, right? So, what types of things am I talking about? I'm If you could go back a couple of decades and get into, multifamily. When I say couple decades, longer now. If you could go way back and get into multifamily and owned a few things that you had probably less than 50% loan to value on, you would be you would just see this tidal wave of multifamily going up in value. Okay, single family did it too. Single family did it. Other assets did it. But where it's really important is to see that people are going to be coming to buy what you may want to sell in a couple of years. Okay, and who else is going to do that besides the institutions? So the institutions are going to just suck it all up, and that's the institutional vacuum. Okay, so you're going to be looking into fragmented categories, like your local mom and pops, types of operations. If you're looking at a business to buy, you're going to be looking at, what is going to have a lot more value when this starts taking off. Okay. Surging rate proof demand. Okay. Demand for affordable, flexible, rural style living keeps climbing. So this is a category that I kind of handed to you. Okay. So surging rate proof demand is a category that sits way off onto itself, but it is a supply that is very low and a demand that is high. So when you have that equilibrium in your favor, what you're doing is you're creating the opportunity for the no matter what happens, if interest rates double, from right now, I think they're around like six and something, 6 or 7, and they go to 14%. Is somebody still going to go get a mortgage to buy that from you? Right. And to us, in my experience, if you can find rural, nice properties, real estate, or build it, that's where the supply is that's where the demand is always going to be, because people always have, but people are starting to see it more and more now. They don't mind the 45-minute commute to work. They don't mind living out of town. They want the seclusion. They want peace and quiet. They don't want, the HOAs. They don't mind the extra things that come in line with that. So rural is a very, very good place to look. The engineered appreciation. So this one is one of those value add opportunities. By this, you can, if it fits into your category of of vetting, that's great. But I'm talking about like the just the rehabs or the fix and flips. Those can be really good, but you have to be in the trenches to really get the most value out of it. Because if you are simply um, hiring a general contractor to come in and do that full rehab for you, you're likely not going to come out where you need to be. So the other side of it too is people go into those fix and flips not knowing the cost of what it should actually take. Prices for materials and labor is going up so fast right now since 2020. It's insane. The the ability to properly calculate that is super hard. So work with a contractor that is going to give you the pricing for these things. And he's not even going to be able to give you a ballpark figure. If he is, he's lying to you. When I say ballpark, he's not going to be able to tell you, hey, any rehab, just calculate X amount of square feet. That's a lie and illusion because it's just his foot in the door to stop the door from shutting on you so that he can get in and pry his way into the project. Okay. So what you want to do is make sure that you know what the costs are going to be when you start looking at fix and flips. Okay. That plus the purchase price is going to give you the after appraisal value. So there's other things that also work in this category. Okay. So if you can own a part of a business, going back to this whole opportunity, if you can own part of a business that actually does this for an income, then you can actually use that to your leverage. So the more vertical you actually get involved with the process, the more success you're going to have coming out of this, right? So what does all this boil down to? It boils down to finding something that is a real asset that is waiting for institutions to start sucking it up, and um, you know being able to add that value. How do a lot of people add that value? How do I add value? I build, because I own a development and construction company. What we're doing is we build on the lots, or we convert the raw land, and we take and we build, so we have the engineered appreciation into it, right? So going back to that bank statement or the bank appraisal situation that I talked about earlier, I have never had to put any money down on a project, right? Because the quote that I give the bank, and I've even experimented with this, and I'd love to hold another podcast on that, but I've experimented with this, that if I come in low, it'll still land where it needs to go, okay, on my bid sheet. If I come in high, I've still never had to, because I was always able to cut my numbers back, okay? That's the value of being able to add truly engineered appreciation. It's not just about, hey, let me hire somebody to come in and do all this work. You probably lost out of 90% of opportunities, okay? So I will kind of wrap this up with this. I hope that made a lot of sense to you, viewers, because here I'm going to give you another situation. This is math. I'm going off of memory here, but if you have person A and person B, okay, person A is going to deploy $100,000 today. It's going to go buy an asset. Whatever the loan balance and whatever he finances is irrelevant to what I'm about to say. So let's say he goes and buys $100,000 in property. Person B is going to wait 2 years until they finally had it. Rates didn't move. There was speculation the whole time. They thought the rates were coming down. They actually could have gone up. But let's say they're at the, they waited, okay, and rates did go down. So we'll give it to their favor that the rates went down, and they buy $100,000 worth of real estate. Not only did they lose to the appreciation from 2 years, that property went up in value over 2 years, but also they lost 3.2% during that time. Okay. So they lost what, $6,400 just in 2 years on their $100,000. Now here's where the numbers get really interesting. Person A is going to refinance, and I think my chart shows 24 months. That person is refinanced, cashed out, and took their $100,000 and deployed it into another project. Okay. Person two is just bought, timeline keeping the same. Person two is just bought. It's going to be 15 months to be able to refinance at the same amount. Pardon me. So 15 months, that person in theoretical territory, that person has the ability to refinance 15 months sooner, but they're also 15 months later to the game. Okay. So person two is already, or person A is already under two properties. Person B still on their first. That's the difference. So you could compound and exponentially grow that chart. You can build that right in Excel. You could do it with, you can tell chat or, Perplexity or whoever. You can tell any of the AIs to build that for you. But anyways, that's it for me. If what I've told you right now has been helpful, I really hope that you're able to use these practices in your daily life to make a judgment call. Um, if this type of investing doesn't suit you and you want to look at other opportunities that's more passive and less hands-on, I would invite you to join us into one of our funds, and we would happily show you the terms and everything like that and run you through the pitch. And what we're doing is we're actually building barndominium developments. So we're taking raw land and converting it, doing the horizontal and infrastructure there, and we're putting barndominiums on that. We see the barndominium as being a huge institutional vacuum, and we're one of the first to actually pioneer this style of development. So um, I think I've got a slide here that here's how we're capturing it. Really, this is not a sales pitch, but um, go to our website. It's fortifiedcapitalllc.com, and that will really be able to point you in a direction to book a call directly with me. I'd love to run you through the opportunity and show you what the terms look like. It's for accredited investors only, so make sure you understand that going into the call. But without further ado, I'll leave you with that. Thank you for everybody that let me reschedule. Do we have any questions in the chat? I'm not seeing my chat bar. I need to open that up. There we go. Alrighty, no questions. But great. Thank you for everybody being here. Appreciate you.